All right, sweet. So we might go a little extra tonight, maybe like an hour and a half. We'll see how this goes, but I want to make sure we get through classes 6 and 7 tonight. So we'll do the 1, 2, 3 stuff in a minute, but we got a surprise pop quiz test for you tonight. So
Awesome.
I figured you'd like that. We want to see how you're asking the right questions, and I think you get this stuff. So we just want to talk through a few things on because this is what we're going to do as we get into not next week, but the week after, or maybe next week, whenever we're done with the 9 classes, we get into our trading, like 2 weeks of our trades. We'll talk you through it, and then we'll want you to do the same thing for when we're going through the 2 weeks of your trades. And we say 2 weeks, we're talking 2 weeks worth of stuff, so like 10 days, 8 days, whatever. So if that's spread out over a month, that's fine. Don't worry about it. We're not going to limit you to 2 weeks. It's just based on schedule and your ability to trade and stuff. But as you know, I'm a big SPY guy because it's not the best thing to do. It's just the best thing for me to do based on the amount of time I can put in during the day and consistency and knowledge on a single underlying. So I'll start off, and then I'll go to you to see how you kind of would have traded today. But here I am looking. This is the screenshot from yesterday. So this is at the end of the day yesterday where the SPY is sitting, and it's a mess. And the reason I want to bring it up now is because this is, if you can get this, everything else is easier because it's a complete fucking mess right now. You've got the 20 above the 50, so that's good. That's in order. But then you've got the 5 and 10 beneath. You've got it riding at, it's right at the 5. It's above the 10. It's got overhead resistance for the 50 and the 20. It's got the 100 beneath. It's got the Bollinger Band beneath, and it's got the 200 well beneath. It's got this trend line resistance overhead, and it's got some support, price support underneath, as well as, I wouldn't necessarily call it Bollinger Band support. I'd more look at this price support based on what it's done twice now. So going into this tonight, or sorry, last night, what I'm thinking about for today is, all right, it's obviously stopped at resistance. If it clears this, it can probably make it to the 20. If it can clear the 20, it can make it to this trend line. So my up thesis is to the 20 or to this trend line. My down thesis is back to today's low, and if it clears that, it can go all the way back down to this price support. So that's where I'm thinking going into today as what I'm going to do trade. I also know it's Fed day, so I'm taking economic calendar in consideration, knowing that markets are usually kind of quiet until 2 Eastern when the Fed makes an announcement, and then it can get kind of froggy. So that's what I'm thinking. Not the best setup. In fact, it's a shitty set. There is no setup. It's just, hey, this is what I play. So that's the kind of stuff you think and you go in through. And then I go, and on that trade thing that I gave you, I sit here and I go, all right, and I write down the 20 SMA is 211.15. All right, so I'm looking at 211.15. The 100 is 208.98. So I'm looking at 209 and 211.15 kind of as windows, and I can go to my lower Bollinger Band of 208.17, and then obviously I have this price of 207.75. So all those things are written down on that sheet that I gave you, and that's what I'm thinking. And then what I'm going to do is move this to where you can't see it. Well, good news is you can't see it. Bad news is neither can I. Here, hang on a second. All right, let me get to 15 EMA. Move this sucker over. All right, and bring it back in for you. All right, so based on what we talked about yesterday, we talked about, pullback trading and reversal trading, quick pullback buys, and the regular, support and resistance. Think about those. We're not going to talk about red to green right now for this example. So this is the 1 minute. Realize that this is just what I use for the S&P. I sometimes use it for others. I don't, but I always look at the 5 as well. But here's what we get. Okay, so we get a gap up showing strength on the open and a quick little run up. All right, and then it goes. So now, right now, do you see, based on what you've learned, Is there anywhere in this 1 minute that you have any ability to enter the position?
Not yet.
Right. There's nothing. So anything you do here is chasing, and chasing is where you lose money. Chasing is a way to make a lot of money if you get lucky once or twice, but overall you end up losing. So it's a bad habit to get into, especially the worst thing that can happen is you chase and you win. You're right. Right's not even the right word. You're lucky on the chase and you make money because then that reemphasizes a bad habit. Okay. So, all right. These are the minutes going by. Is there anywhere for you to enter really? Any pattern there?
No.
Nope, no pattern. No pattern. There's a little, that candle could be a reversal candle if you study your candles, okay? That could be a little indication of a reversal topping. It's also coming up around that 211, all right, which we think might be some resistance area.
And I guess my other question would be, what is driving the gap?
Just yesterday was a little bit strong, and it just continued on from yesterday. So nothing major, nothing. There was no like 8:30 economic data that came out. There was no news that Greece has been, they just found a couple of $1 trillion and the problem solved. There's been no world peace. There's nothing.
Those increased candles after, they're based on low volume too. There was only good volume on that initial.
Right, exactly. There's one big volume at the push, and then it just goes up. All right, and now look what happens. Boom. Big drop down at the 211. All right, and it's kind of cheating here because I got a trend line drawn, but on that 211, all right, in that minute on that pull down, is there an entry?
I really want one more.
Okay, and fair enough. So that's what you said is a conservative approach, and that's a good call. Remember how we talked about a quick pullback trade?
Yeah.
If you're ballsy and you think there's a reason for support, because that is a quick pullback to the VWAP. That is not a 3 candle over 15 minutes, in this case 3 minutes, low volume, nice gentle pullback to support and the go. That is a quick pullback that if you're going to be in this, it would have been, hey, let me get in right around here at 280 with a stop at 275 or 210.80 with a stop at 210.75, just playing a bounce off the VWAP. That's all that is. That's a quick pullback buy. This is where you're going to risk a nickel, realizing that you might lose 7-8 cents because if this just shoots back down, you're out. Why is this somewhat safe of a trade? Look at the volume. So yeah, it's one candle. A bunch of sell orders were sitting at 211 that just crushed this thing, and that's something you'll learn over time. And if I go to the 5 minute, hopefully it won't. Yeah, shit. Okay, don't look for a second. It doesn't keep it where I had it. If we go to the 5 minute, it doesn't look as horrendous, and it comes right to the VWAP. And that's why I'm always back and forth, bouncing back and forth between the 1 and the 5. Then if I go to the daily, I'm looking at 211 on the daily. What's right at 211 on the daily? What did I just say? The 20 is at 211.03. So did we expect that? 100%. 100% we expected that. Here, don't look again for a second. We expected that pushback at 211.03 at 211. So what other trade did we learn about yesterday? As far as reversals go. So when could you place a reversal trade? Like if something's kind of going up, but it's not like crushing it, and you're looking for a spot, and you want to do a low risk entry on a reversal, running into some significant type of resistance, right?
Yeah.
Okay, so is a 20-day moving average in a weak market, a mediocre market, could that be resistance?
Yeah, I think so.
Yeah, 100%. So you could have gone and you could have had a short position sitting in there at 210.98 or 211.05, whatever. Remember the 20s at 211.03. Where does this thing get to? It gets to 210.99. Where does it get to here? 210.98. And that's where those sell orders. So a bunch of people are sitting there and they're thinking, hey, this thing gapped up on no real reason. There's, the Feds this afternoon. Nothing significant happened. It's in no man's land. I expect, hey, if it hits the 20, there's not going to be enough buyers to push this through because there's just not a spark yet. So they got a bunch of sell orders sitting there, and sure as shit, it goes up and it hits it, and it takes a minute because what happened is probably people had them sitting around 211, whatever, and it didn't get to that, and they just move them all down a few pennies and then just crush it. So, I say a bunch, it's 500, not even 500,000, but enough that there were more than the buy orders because there's no real support here to buy, and I think it shoots down. So you could have had a short sitting there at 210.98, 96, 211, 1103, whatever, and then that's a reversal play. And then boom, sure shit, it goes right to the VWAP, and it slows down at the VWAP. Why? Because as this is going up, people are going, hey, I'd like to be in this. It looks like it might move ahead of the Fed, but I'm not chasing it. Let me put my entry around, 210.80, 210.78, whatever. Let me put my orders in to buy as it hits, if it pulls back to the VWAP. Now they're probably looking for a more gradual pullback, but they get a no shit quick pullback. All right, right to the VWAP. Let's see what it does. Overshoots a little bit. What's this right here? This is all the people that had orders in, and it shoots right up as it hits the VWAP, and then it comes back down. All right, more people sell, and then it kind of settles out for a minute. So I haven't played anything yet. I'm still watching and waiting here, all right, for a little bit more of a pullback, because I'd like it to come back to the 15. And I see this now. This shows you, hey, we're getting a little bit more time now. It's settling down. It's kind of hanging out, so there might be an opportunity here. Remember, this is the 1 minute. So now is when I'm interested. Why do you think I'm interested now?
Oh, because I see it starting to form like a consolidation within a flag using a VWAP as the bottom of the pennant.
100%. And what else is it doing? It's making a series of higher lows. Higher low, higher low, higher low, higher low, higher low, higher low. So what that's telling you is, hey, people are getting antsy, anxious, confident, whatever, and they're stepping in front of each other to go ahead and buy at a higher price to form this flag. You're 100% right. So as that goes, I'm watching it, and boom, it doesn't work. 100% gets your interest, and if you did it and you got in here, all right, you bought in it. Now this is where you'll see it might be a little too early. I didn't buy in, but hey, Dirty, can you mute? Because I hear myself through your. Okay. If you buy into this 210.80, no big deal, right? Because your stop's probably at 210.75, so you get stopped out. No big deal. I didn't get in yet because I was waiting for this thing to flag more and waiting for it to get a little tighter. But now what do you see? What is this that we learned about from yesterday?
Well,
if this was a quick pullback to the VWAP, what is this here?
now it's falling back down to the next.
Yeah, it's not pretty. It's not three candles. There's a little more volume, but it is coming back to the open, and it's giving us what? What kind of entry is it giving us? What kind of risk entry?
Well, that would be a lower risk entry.
Low risk entry. So it's not a perfect pattern. It's not a flag. It's not a triangle. It's not consolidating, but it's giving us a low risk entry that for whatever reason it opened there. There was strength there and it held. And now, if this would have opened here, come down and run up, I might not just jump in here. But since it opened and held, and that's the key, it opened and held, I'm in. And I take
so you're looking at it like you're getting a good deal on getting back in what was previous strength.
Right. It opened and held. It didn't show weakness on the open for whatever reason, and it ran. And there was like a buy program or something decent here that ran this thing up to 211. I think it can get there again and maybe make another run at this 20 SMA and continue on. So I go ahead and get in there. And I got in on this candle here. I can't remember my exact price. I think 262. I know I had less than 7 cents of risk. And this line I didn't have drawn yet. This line comes in a second. Now, where's my target? Now that I'm in here, where's my target, do you think? This line is not here yet.
I would take your first at the VWAP.
Yeah, exactly. Exactly. I'm going to look for a little bit at the VWAP. So I think I had a 73 sell in there. So from 62 to 73, 12 cents, no big deal, but it's 2 to 1 of what I was risking. and I take some off there.
And see if it punches up.
Yeah. And it hangs out. Now I have, this line is now here because it had a high here, and I had a little bit of a line drawn here that I got rid of, and I moved it up to here. So initially I'm thinking right here, so I'm watching, I'll go ahead and draw it. I'm watching this here, and if it breaks down through here, I'm probably selling everything. But it goes up, I got a new line here, and I'm okay. I'm okay with it, so let me get rid of this. I remove that line, and now I draw this line, because this is, you know, higher than these, so I've got a new line of resistance there. And it's just hanging around that area, and it starts to fail, and I cashed out. All right.
Okay.
Now we're just watching.
Whereas at that one, you know, where it peaked up there, got closest to the you know, the white trend line you grew, where it got closest there, you know, if that next candle would have been green poking up through it a little bit.
Yeah, then your target is the high of the day. So then you take some more off of the high of the day, and then you look for a breakout of the opening range. It would have been an opening range break. Had this gone on, you're looking for an opening range break, which was one of our breakout trades.
And then you would have set the out right at the, once again, you set the bottom out at the VWAP, or...
Okay, so my target would have been around 96, because you got to give it a couple, everyone kind of lowers it in case it fails there. And then if it would have made the breakout, then my stop becomes the opening range high.
Okay. All right.
So I'm raising it up. Now you could draw little trend lines here, like, okay, hey, it ran here, and it broke that. So this little run-up is no longer valid. So that's where you start watching it for do I need to get out? And then as soon as it fails at the VWAP, and it can't clear this, it's staying below this 15 EMA, you know, I'm out. And I'll show you this on the 5-minute here in a second. So in this one trade so far, you could have had a resistance trade, a quick pullback buy, a pullback, and now that's it. Then as we go on, now I haven't traded it since then, all right, but I'm watching it for another trade. And this very defined resistance here now. Look at that defined resistance. And you finally start seeing some, this was initial support, and that broke. All right, so now I'm looking for support again. I've got defined resistance. This is invalid. And I'm looking for new support. So I have a low here. I have a higher low, higher low. All right, I'm not going to trade this. You could try to do a quick trade, but you're only really looking for, and I'm drawing this out, so I have this drawn before this happens. And look how that trend line, along with the VWAP, you can expect failure there. And see how that works?
Yeah.
Now you're looking for a break.
Are you also looking at, I mean, would you have done that because it was like right at 11? Or is it different today because it's a 2 o'clock announcement?
That's another part of the reason not to be in it, because it is 11. You're exactly right, because it's the middle of the day. So it goes, and then there was some sort of weird thing, and my next thing I'm looking for is I want to see what it does prior to the Fed. Let me zoom out some on this. So nothing going on in here, and then it finally fails this kind of support area, and you see once it fails, you get a pretty decent drop off. But where does it go to when it drops off? Right to yesterday's close.
Yeah.
It holds. It just kind of hangs out around there.
Now it's just waiting a little bit.
Just waiting, and then it fails. So once it right in here, it hangs out there for a little bit, and then boom, it fails. So as we're getting close to, I don't know if this is going to be, I think this is my time, right? Or I guess I can tell. Does it start at, starts at 9? Okay, so no, this is East Coast time. I'm watching around 1:30 to see what's going to happen prior to the Fed announcement, to see what people start doing, to start trying to front run it or not. I haven't done anything through here. And then I see this going on. All right, this is coming in. It's low volume, but this is coming in prior to the Fed announcement. So I get in at 209.60 something with my stop beneath this. And it breaks, but it doesn't. I think my stop is like 55. It's beneath this consolidation right here, 57, whatever. So it breaks it for a minute, but then it goes right back. Breaks it again, but it holds that, that 60 area. And then look at that little run into the Fed. And I got out right around here. This first red candle, I got out. Why? Because it's running into 210, and also because it's right before the Fed announcement, and you never know what's going to happen. I think it's zing up $2 or it could zing down $2. And then look at the craziness you get with the Fed announcement. I mean, it does exactly that. It drops down 60 cents, runs up, 40 cents, which is from the down as $1. And then I'm watching to see if there's a pattern that forms for an entry. Let me zoom in now. So in here, I get to pull back to the VWAP, and I get in around 38 here. I don't know if I got in at 38, or I think I did get in right at 38. I didn't get filled on all of them though. And that's go ahead.
Okay. Were you listening to the Fed announcement, or were you tracking it on a blog or something?
No, and here's why. Because who fucking knows? Okay, say they announce they're never going to raise interest rates. Well, then that causes somebody to think, well, that's bad news, and it goes whatever. Or let's say they're going to raise them tomorrow. Like, you'd think raising tomorrow causes the market to go down, but maybe that's what they wanted. That's why it sounds like everything's so weird right now, that good economic data doesn't mean good news, and bad doesn't mean bad news, and so it doesn't matter what the announcement is, because then you're just guessing on your interpretation.
Too complex to project.
Yeah, I mean, in a normal world, it's not. In a normal world, you take the data, and it means if it's positive data, the market's going to react positively. If it's negative data, the market reacts negatively. But in the environment we're in, you don't know what they're going to think. So I don't care. I just know that something's happening at 2. I want to wait and see how the market reacts and what appears to be the overall opinion, and then trade accordingly.
Yeah.
So I got in around there and got a little burst, and then it flags, and it kind of goes sideways, and it comes back down. So I got out on this red candle because it wasn't holding. So that trade didn't end up doing much for me. And then later on it goes. Then I was done. It does kind of flagging, yeah. So here's when it finally kind of consolidates here, figures out it wants to go again, but I didn't have I should have had another entry here, but I think I was getting ready. I think I was driving home during that time I was out of there. I was just happy that it didn't react negatively. So I was good at that point. But the reason I'm showing you all this is just, you see when you have a plan and you watch and you have different levels of support and resistance. You can do resistance trades, you can do pullback trades, you can do your normal flag and go, and then you're watching and coming up with a price theory. And here's that 5 minute I wanted to show you down here where going into the Fed, normally this is not a buy kind of area, because this is resistance. Look at all the resistance above this thing on the 5 minute. And this is just the 5 minute. You got the 15 minute, the 30 minute, the 60 minute. This has nothing but resistance above it. All right. And where is it? 209.50. Where is it on the chart? It's not at any type of support level. Well, I guess it's at the top of this, but that's not really support. There's no real support level there. It's just simply that the Fed announcement's coming up, and somebody's walking this sucker up. Somebody's in here kind of accumulating some shares, whatever, and they might know more than what we know. So that's why I got in on this. Normally, this is a bear flag, looking for another, moving average just to catch up from above and push this thing down further. But today, based on, what I knew was coming up and what it appeared might be going on, that's why, I had a low risk entry. Why not? I was already up for the day, which is not the right attitude to have, but, I had a low risk entry, a few pennies. My size was smaller. Those are the things you do. Like, hey, it appears this. Let me get in. Let me size down so I lower my risk both by my stop and my share size, and see what happens. you know, and it worked out. But anyway, so just some things to, yesterday we gave examples and went through the class and I showed you charts and stuff, but there's how a trading day played out on a a Fed trading day where things can be kind of crazy.
Okay.
All right, so let's go to the PowerPoint and let's show a couple more charts from yesterday. Pullback trading, we talked about Mobileye, all right, and here's an example where the stock's been up, all right. So you're kind of how I just went through the price theory on the SPY, where hey, where can it go above? Where can it go below? Where do I think it's going to go? What's going on with this this ETF? In this case, what's going on with Mobileye? It's been up. It pulled back on the daily to support. We showed you that yesterday. So we expect it to kind of run, and maybe it's on the news. It's all the hype right now. So we expect it to keep running, right? So it's kind of hard to see here because I had Doug show 2 days worth, but it's up. It finishes strong on the day. It gaps up on the open, and it pulls back to resistance. All right, pulls back to the 9 EMA. And then what's it do? It runs. So that's where you could be looking. And what else is there? All kinds of price support from the previous day, right? So you would never trade this just out of nowhere unless it was part of your trade plan and you were watching it. And if you're watching it, you have a price theory, and you have a game plan. All right, I'd like to be in Mobileye. I'm looking for a way to get in. I didn't get in yesterday on the finish near the highs. Pulled back to the VWAP and held. Let me watch it. Hey, gaps up, fails, but I know this area here at 51, call it 60, 70, whatever, is price support. It pulls back to that, and the 9 EMA is there. Boom, I'm in. And then look what happens. Pulls up, flags. You could add. Runs up, flags again. It makes those higher lows. Nice trend line. Comes up, flags again. This trend line here is over, but what I tell you, that's a 70-degree trend line. That's not going to last. All right. 45-degree trend lines last. 70-degree trend lines don't. But as long as it does something productive, which it did, it flagged here, you can stay in. No reason to get out. Runs again, and then that's where it kind of fails, and that's where you could be out with your profits from 51.60, maybe an add, maybe not, up to 53.50, a couple dollar gain there. So there's one example. We hit reversals yesterday. All right, just like today, I showed you just now on the SPY, where if your game plan going in is, hey, I think that I'm looking for a failure of the SPY move at the 20. If it makes it to the 20, I'm going to short it. I'm looking for a reversal on this. I'm not going to mess around with trying to get in. Maybe that wasn't your plan. Maybe your plan was going long, but it gaps up, and you're like, well, this thing's only going to run so far till it has resistance. I'm going to do a reversal play on it. Same thing here with First Solar. It gapped up. It ran. There's resistance from the daily chart. I can't remember what it is. Doug, do you remember what the resistance was from the daily? Moving average or price or whatever, but Bollinger Band, something. There's a resistance there, and as it goes up, you get a red candle, kind of overshoots it. You get a nice, that's a reversal candle, and then you get in. And then look, oftentimes from failure will come these type of sell-offs, and you get, if you get in at 52, 85 with a 20-cent stop, 20-cent stop is going to be 100 shares there, or I'm sorry, 1,000 shares, and 1,000 shares, you get a rundown. Even if you take your first profits down here at 52.20, $600. So that's how you could have a plan of a reversal trade. But once again, it all comes from watching the stock, having a plan for trading that stock. Green to red, this NAV has been in a complete downtrend. All right, you expect it to continue on down. This is where we talked about, something you're looking for. Remember, there's two types of red to greens and two types of green to reds. Continuation and then reversal. So this is a continuation that you're looking for. It's in a downtrend. It opens up green. You think this is like a weak gap, a dead cat bounce, whatever your price theory is. You expect this, to fail, and it goes, you get a red candle, another red, and then sure enough, this is a green to red move that you can short against the opening price, and then it sells off. Now you get some of these greens come back, you got to get out of it, but it ends up failing again. So, that's more of a scalp trade, but that's what we're talking about on a continuation of a move, and then a reversal of a move, which we'll get more into tonight. Here's something that's been going down, gaps down into support, and as soon as it makes it back up and turns green for the day, all right, on pretty good volume, you can get in this trade right around here with a stop at where it would be, negative for the day. So a close stop, you get in where it turns positive with your stop right below that where it would be negative, and then you get a nice run up, and then you're out after this move. And this is not necessarily the market right now where you get a lot of continuation. So you're looking for those scalp type trades or whatever. So there's an example of that. And I think, okay, so the one thing we didn't get to yesterday was the 1, 2, 3. All right, so let's pick up there, and then I'm going to turn it over to Doug for any of his inputs while I take a break before we go into tonight's stuff. So, the 1, 2, 3 reversal, once again, another reversal trade, works in all time frames. It's going to work in both long setup form, which is the end of a downtrend, and the short setup, which is the end of an uptrend. The 1, 2, 3 uptrend is like an M. The 1, 2, 3 downtrend is like a W. You get it, the points of the letter, and it's making a higher low for a W reversal, and it's making a lower high for an M reversal. All right. So the long setup, it's a downtrending stock that fails to make a lower low. It ends those series of lower highs and lower lows, and you can either trade it as a confirmation once it breaks like the neckline or the trend line like we drew yesterday, or you see in what did we draw yesterday? I can't remember the example we gave yesterday. Anyway, yesterday was like a five-legged W, but you saw the break of the trend line. The short setup is the end of an uptrending stock that fails to make higher highs and higher lows, and then you can once again trade that neckline break. You can either trade it once it makes that lower high in an M or that higher low in a W, and that's anticipatory, or you can confirmation trade it once it actually breaks out of that the trend line there. You can also use prior candles for your stops. You want to make sure in volume supports the direction of your trade. So if it's a reversal from a downtrend, as it's moving up, you want more volume. And if it's a reversal on an uptrend, you want higher volume whenever it's moving down. You've got kind of on page 81 of the book, you've got the 1, 2, 3 on the MBIS where you see how it breaks that trend line that's drawn. And you also see that how 3 is higher than 1, so that's that W forming. For FireEye here, it's kind of it's not the prettiest W that you draw this way, all right. But this, if you look at it, tilt your head sideways to the left there. This is a W this way. Here's a low. Here's a higher. This is the low. This high is higher than here, which signals possibly a reversal here. Not a lot going on with volume. But then as it comes here, you get higher volume coming in. So you can buy on this green here as soon as it starts out above with your stop right beneath here. So that's a pretty tight stop, pretty low risk stop. Confirmation, you don't want to draw the trend line like this. It doesn't break that. You've got a trend line coming across here. And once it breaks above this high, all right, that's where you can enter confirmation with a stop just beneath that high, because that high should not be support. You see it kind of fails over here, but then it goes again. All right, you're looking for that quick move. You got anytime you're doing a reversal trade, whether it be a W or an M, you're always going to have resistance overhead or support beneath. So it's kind of a scalp. There has to be a catalyst to why it might reverse. And in this case, the 50 DMA is here in the blue. All right, so the 50 daily moving average. So you're expecting this thing's been coming down. It actually went. It's actually a red to green. A green to red play. So it's been downtrending. It gapped up, it hit resistance here, so this is a resistance play. Then it went red for the day, so that's a green to red play. Right, it comes down, and then you get a 1, 2, 3 reversal or a W reversal for that play. So you see that one stock can give you multiple plays throughout the day, and never be afraid to trade a stock both ways. If you're right and you continue making money, trade both ways. If you're wrong, if you're right, you'll tend to be right throughout the trade. If you're wrong, you'll tend to be wrong throughout the trade and compound your losses. So it's just a mindset thing. It's a get even thing. It's a seeing it wrong from the start thing. Because if you're seeing it wrong, you're probably going to continue seeing it wrong, and you're better off not trading it multiple times. If you're right and you're seeing it right, you tend to continue seeing it right, and you can trade a stock, multiple times. All right, so that's a 1, 2, 3. With that, I'm going to go over to Doug to see if he has anything to add, just general thoughts or any charts he wants to show or anything else, while I switch up PowerPoints and take a break for a second.
Hey, Greg, what's going on?
Hey, Doug, how are you?
Good. Let me see what I trade today. FBYE. See if there's anything relevant. Let me get my screen on here. Okay. Then you have to like turn it over to me, right, Chris? Or I can do it. I got it, I think. Yeah. All right. So let's say I did FBYE today. So this is a pullback trade, Greg, here. So FBYE, here's the daily. You can see it's been an uptrend, and it's getting overbought. Not yet, though. You can see it popped up, made a flag, popped up. Yesterday, kind of rested a bit. So I was watching it today. Let's zoom out a little bit here. So it gapped up, and the market gapped up. So on gap up days, people are a little more cautious because sometimes you don't get much of a move because a lot of the move can be absorbed into the gap, Mm-hmm. So I knew yesterday's high was here, and you can see what happens when it opens up. It basically runs into yesterday's high and fails. Kind of flags here and says, nah, I can't break out here yet. I need to rest a little bit. I guess some of those people were taking their profits. It gapped up. They were holding it overnight. It gapped up. They start taking their profits or whatever. And so it pulls back. So I'm watching the 9, and this would be kind of like one of those quick pullback buys if you just put it in order like right at the 9, and grabbed it down in here. But I was a little more cautious because of the gap up and Fed day and blah blah. So I watched it, and I watched it kind of consolidate, and you could see the 9 EMA like working its way up, So it's telling you that the moving average working its way up like that is telling you that the average prices over that short time frame are getting higher, and it's got higher lows, and
it's like making a flag based on if you drew a top line.
Yeah, and that's kind of a technique. You can watch it, and then when you see we're getting into little nuances now, but you see it kind of break through the VWAP here, and you might be like, oh, all right, I'm going to go long. But the 9 EMA hadn't caught up yet, so it comes back. It doesn't break out here. It comes back again, and we know that the big key is if it breaks above here. That's the opening range breakout. It's telling you that it's rested, and then you're looking for buyers to come in and push it above, and that's what happened. So it pulls back. The 9 kind of crosses above the VWAP. Buyers come in. The volume, the pullback volume was lower, so the red candles are a little smaller. Volume starts to come in. And boom, so I entered somewhere in here, probably a little late, but I guess I was looking for confirmation. And it breaks out. You get another pullback, so you're watching, like I'm looking maybe at the 2-minute chart. So you can see it it breaks out, it pulls back, it's holding the moving averages here, kind of consolidating again. Shoots up again, and then so you can ride this thing, and you really don't have much of a target because it's at highs. It's at like 52.
You buy consecutively. Pullbacks. Did you?
No, did I add? I did add on this one. I added at 54.15, and then I got out. Let me check. I didn't get a whole lot out of the ad. I got out at 54.47. So when it broke above this high, I sold some, and then ended up getting out some at 54.15 again, like some that was left over.
Mm-hmm.
You know, when it came back down, I got out flat. So this is up a 52-week high, so you don't have much of a target. You know, like you really don't know what to target.
Yeah.
You know, like maybe like whole numbers and half numbers, like 54.50 obviously would have been a good target. I like the pivot points. That's what's up here. So that was probably my ultimate target. But really, you just have to try to scale out, sell some, and then when it breaks down, you're done.
So real quick on chart
Mhm.
graphics here, because I got your import.
Yeah.
On my Thinkorswim, the solid dotted lines going across.
Yeah.
The purple, the orange, the red.
Yep.
Okay, remind me what those are signifying. Previous days, highs and lows, and then.
Yeah, they're called pivot points, and I forget how they're calculated, but it's something off of the average of like the last 2 days highs and the last 2 days lows, or something like that. The open, the close. I'll look it up while look it up while you guys are talking.
That, incorporated, so they're, I don't know, they're kind of like statistical or like Bollinger Band, similar kind of bracketing pieces.
Yeah, I mean, it's just something that people, probably in the old days, people would figure it out and draw it on a chart, and it's just something people use. Like there's another thing people use called Fibonacci's, which is like, based off the pi and all that stuff. And it's these crazy graphs that you put on here, and you go to the low, and it expands out, and there's all these retracement levels. Like, that's too much for me to watch, but these are easy. And I started looking at them, and it looks like they react, So it's just something that people watch.
So they react either as you're looking at them from a support or resistance standpoint.
Yeah. I mean, if it's, and they are tied, since they are tied to like highs and lows, which I'll look up how they figure it out here while you guys are talking. But to me, since they're tied off like the highs and the lows, those areas are usually support and resistance anyway. Like the previous day's high, is usually resistance there. So, and I just noticed that stocks do. You can see it kind of bounced off that area every time. Yeah. So I just throw them on there. I don't use them. I just use them kind of like as targets or, up and down more than anything. So, like I probably wouldn't buy something at the pivot point for a bounce. But if I was short, I would use that as a target, as a place to take some profit, just because they seem to react to those. So,
okay.
But yeah, I'll look it up while you guys are talking. But
appreciate it.
Yeah, pivot. Oh, sorry. Go ahead, Doug. Anything else?
I'm just gonna look at the 5 here. Yeah, where I got out.
Oh, sorry.
Yeah. So you ride this thing up, and then, I held it. I held my last little piece to the entry that I had on the ad, but just because, what the hell, maybe it'll bounce. But really, as soon as it kind of fails here, makes this lower high and breaks below this guy here, goes through the moving average, that's probably where, you'd get out. It's done. You know what I mean? So that's it. That's all I got.
Okay, thanks. All right, great. Yeah, Greg, there's all kinds of indicators you can use, and you can read about them, and you can see which ones work best for you.
I looked at the studies thing. I was like, holy crap.
Exactly, and that's why you don't want to get or paralysis via analysis, putting too much in there. But a couple of books we recommend. I recommend reading them in there. You'll see very few things other than what we have. Pivot points, Fibonacci bands are good for like retracement. What they do is you take the recent high and a recent low, and Fibonacci bands will show you the 25%, 33%, 50%, 66% retracement levels, and a lot of times that's where support or resistance will come in, because if a stock is strong on those pullbacks, it'll retrace, or the market as a whole will retrace, say 33%, but then it should run again. If it's weak, it'll come back further, and then you'll get more weakness in, and that compounds. So those are just one more thing that you could use as far as overall targets for either a stock or for the market. And you'll see that in some of the videos that you watch that we recommend. People talk about nobody really has them on their chart, day in and day out, but at the end of the day, or whenever they're doing their scans, or or when they're trying to figure out if the market's, what might be a next movement or a pivot point in the market, they'll look at their Fibonacci's and they'll draw it from the recent high to recent low. And then when I say recent, I mean like significant high or significant low. Like for example, if we're doing the S&P right now, you'd put it, you could draw Fibonacci's at this high here and at this low here, but it hasn't been a big enough move. No one's even really worried about Fibonacci's right now because it's just going sideways. So you haven't heard of people talk about Fibonacci's in a long time. But when you get a move like from here to here, then they'll draw Fibonacci's and go, okay, hey, it pulled back, it passed the 33, it better hold the 50, or this was this is not a strong market and it's just showing weakness again, and then it should move on again. So when you get these big moves, you'll definitely see Fibonacci come out and people see what's, hey, 33%, does it hold that and continue on? Strong market. 50%, that's okay. If it pulls back 66%, it's probably going to keep going. You know what I'm saying? Things like that.
Yeah. Okay, thanks.
Mm-hmm. And then pivot points, he's going to look up how they work, but yeah, they are valid. Some people just trade just pivots.
Yeah, I could tell you, here's a definition on Thinkorswim. Support and resistance levels are found in relation to the pivot point, which is the average of high, low, and close prices of the previous period. See the following table. So,
period defined as like
the day. Yeah, in this case, a day.
Okay.
So let's see, resistance level above the pivot point at the distance equal to that between the pivot point and the low price of the previous period. Support level below the pivot point at the distance equal to that below between the pivot point and the high. So so now you know why I don't have it memorized how they figure them out. It's a little bit confusing, but
yeah.
But yeah, so the average, high, low, and close prices. And then they take that and they figure out 3 levels from there. So that's why, let me go back. If you look at, when you look at the chart, you'll see a purple one, that's like the middle, and then 2 red ones above, those are the uppers, and the 2 green below are the lowers, the supports. So there's always 5, That's why. That's how they do that. So it's magic, but enough people believe in the magic, then it could be useful.
Not magic.
Yeah, exactly. Yeah. So, all right.
Sweet. All right, Class 7 tonight's a little shorter, but because we want to get through these trading classes so you can have all this. I don't want to say straight in your head, but at least have it to review and be thinking about. So we talked about pullbacks and reversals. Oh, hang on, controls release here. What's going on? We talked about pullbacks and reversals last night and tonight, and now we're going to get in on full-on counter trend trades. And the reversal is a counter trend. Pullback is not, but we talked about in depth how you want to go with the trend, and if you're going against the trend, it's usually going to be a scalp unless it's a massive snapback or rubber band, which we'll talk about here shortly. So we'll talk about gap trades, some sympathy trades as well, and some combo trades tonight. The standard warning there, remember, the trend is your friend, and a lot of money has been lost going against the trend, and specifically trying to you always hear the phrase, catch a falling knife. When oh, surely it can't go any lower, let me buy here, and it goes lower, let me average down, and then you buy more, and then it goes lower, and then it's just a bad place to be. So you don't want to try to guess tops or bottoms. It's okay to be in on tops for shorts and bottoms for longs that you think are there if you have a reason and you have a low risk entry. All right, and you have to have the mindset that if you're wrong, you got to get out. You don't keep averaging into it. All right, so. The highlight there is that if you're going to go counter trend, you have to make sure the risk to reward is there to make the trade worthwhile, and you got the right mindset entering that trade. There are some very, very profitable counter trend trades but they're there and they work for the right reason. And one of those reasons is an overextended counter trend trade. So I wouldn't say you're so much going against the trend as you're taking advantage of an overextended trend where the trend has just gone, they call it parabolic move. So the stock has gone parabolic. So when you're in it counter trend, you're not in it saying, hey, this stock is done. You're just in it saying this stock has just gotten ridiculous on its overbought or oversold conditions, and it's way outside the Bollinger Band, and it just needs a rest, and it needs rest more than just through time. It's going to pull back or throw back to either support or resistance. So you see that move back, and you're just taking advantage of that move, and then you might enter it again long here in a bit. But if it's crazy extended, all right, which is when these trades work the best, they can be very profitable trades, and they happen pretty fast a lot of times. So for the overextended counter trend short trade, it's going to be a stock that's extremely overbought. All right, on your daily, you're going to have the stochastics over 80. If you're looking at the MACD, you're going to have negative divergence possibly, where that means the stock's making that higher high, but the MACD is making a lower high. It's definitely parabolic, and it must be parabolic over days. So 1 day gap up does not a parabolic stock make. All right, it has to be like up and up again and up again, and a gap and up for the 4th day maybe, and then finally it's just okay. This thing's got it's just like a rubber band. It's stretched too far. It's got to snap back. If there's major resistance overhead, that'll help, but it's not necessary. Sometimes these are overextended because there's no resistance overhead, and it just keeps going and going and going until it needs to come back. And like we talked about last night, and we talked about it when we defined gaps earlier on in class, weeks ago, where you get that final exhaustion gap. So if you get an exhaustion gap on an overextended parabolic stock that goes green to red, then that is, man, that's your moneymaker right there. Okay, so you're not always going to get the exhaustion gap and the green to red move, but you get the idea that if you get all those, then you can be looking pretty. All right, there's the setup itself is, you're not necessarily going to have a bear flag out of this or just some sort of perfectly looking pattern that happens when this does it. It's going to be kind of a break of the like an opening range break to the downside, or it's going to be a green to red, or it's going to be where it just goes, kind of runs out of steam, goes flat for a little bit, moving averages come above it, and it just breaks down, and sellers come in and just crushes it down. So, you just got to kind of look at it, and you'll learn, and you'll see these, and you'll recognize these. And you hear a lot of people talking right now, and we showed you this yesterday. We talked about SHOP being an IPO that has just been, green, 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 and look at this today. Now, what's up here? There's no resistance up here. There's no Bollinger Bands to see if it's extended, outside of those yet or not. There's a nice trend line of support coming up. That trend line is held, and where do we trade this today? What's your entry on this? I don't know. Like, this is, I didn't trade it, but this is just a weird, it's an IPO. It has no price. It has no memory. It has nothing going on. It gaps up. It goes down. This is one entry where you could have gone long for sure, and that's what happened. Buyers are sitting here. They're looking for it. This isn't an idea where, hey, gaps up. It comes back to prior price support and yesterday's close, and all kinds of buyers come in until finally there's just no more buyers. But if you'd entered it at 38 to 41.50, you'd be beyond happy. This is just shooting star. This is just kind of an idea of a reversal candle here, but this thing happens so fast. You can't enter here with a stop above here. That's just too much. But you see how it failed off. So it makes it to 42, back down to 38. But there's no entry here. So you're not always going to have a way to get in on one of these snapbacks and one of these reversals like this. But this is just something that tied in from yesterday to today. And then, counter to that, what we mentioned yesterday is AMBA. People are still talking about shorting this, and there's just no reason. There's just no reason to be short AMBA. You know, if anything, it's a continued long. It would need to be up out here. You know, if it jumped to 130, then 140, and then 150, then it might pull back to the Bollinger Band or something like that. And if you can get a nice entry, that'd be good. I have Mobley right now. I don't think I have. Okay, so Mobley, here's another example. A pull back to support, run. If this went a couple more days, then you might get a pullback, but it's not, you know, it is barely overbought, strong volume, run up. It's all the rave right now, but it'll fail. It'll get too extended, and everyone's like, all right, sweet, take my profits, I'm out of this thing, and it'll come crashing back down. It does have, I think, yeah. So it's got this prior high. So my guess is they're going to run this thing up to $58, $59, $60, and then as soon as it gets there, that's the time where this is a resistance trade. There's a way to short and do a counter trend trade on this thing on a snapback back down to a reasonable, you know, $52 or whatever. So that's where you're looking on these. All right, what do we have here? We have a exactly this. So we have a stock. Look how far it's gone, and that's the other thing you look at. What's the move been? Like this thing went from 52 to 65, you know, pretty rapidly. A little bit of a pullback and go, but now it's outside its upper Bollinger Band. It's extended. It's not been there for days, so this is by no means a buy the book setup because you want it to be there for 3 or 4 days and way outside. But if you're watching it, you know, closely, there might have been an entry in here, and I think that's the next chart. It comes up. This is a high from the previous day. All right, so you're watching that, and if it fails that thing, you can get in with a stop above the high, and then that's where you get that quick flush down, you know, right there. So there's your example. On an overextended, not crazy overextended, but an extended counter trend short trade on HNT. All right, for the so you could call these rubber bands or overextended either way. You get the point. It's either going to be outside to the top or outside to the bottom, and you're looking for a play in the opposite direction. So a rubber band setup short is the exact same thing as well, there's a rubber band setup short and there's a rubber band setup long. All right, the characteristics are going to be the same, only opposite. It's either going to be overextended and overbought or oversold. If it's overbought, you want that 80 minimum of stochastics, 90 is best, and the more it gets stretched, the greater chance of a snap back. It has to have made a substantial run-up in a period of few days. A strong pierce of the Bollinger Band is what you're looking for. If it's been coiling for months, then pierces, setup's not valid. It has to be making a move over numerous days until finally it's just exhausted. You want, and if you can get a candle that's completely outside of the Bollinger Band, you know, that even increases your probability of a snapback. It usually has a large volume increase, kind of a tipper information there. It usually has a large volume increase the day before the snapback. It'll get that blow off exhaustion volume. One last run, one last buying spree. Everyone's in, or either everyone's short one last time, and then all right, it's just done, and then it goes back the other way. Trading these, you know, you'd like to wait for the stock to open all the way outside the Bollinger Band, if possible, and then get short once it shows sign of weakness. Once it goes from either green to red intraday, or it breaks through a significant level of support, breaks out of a flag or breakdown, like I said, a breakout, a flat bottom breakdown, or breaks through significant moving averages or whatever, you'll see heavy selling volume come in as folks are just, you know, getting out of that trade. And then obviously, just like before, you'll apply the rules of the trade, whichever setup that you use. In the book, Mankind shows you an example, and if you look at Mankind in the book on page 83, that's kind of where we are getting in that shop and AMBA if it keeps going, and MOBA if it keeps going, but it's just not there yet. It needs to do that for several days, and then maybe a gap up outside the Bollinger Band, and then a pull back down, and you're looking for that fail of the previous price or fail of a significant area of of a support or a nice overextended green to red. So here's ANTH. The Bollinger Band's at 945. It's had a nice deal here, and then a nice run up out of this flag, and it's just flags again, runs, flags again, runs, and then it gets outside of that. The high of 975. Bollinger Band's at 945. So it kind of flags here, and once it's at this high, it's been running at flags, it fails. You can short against this trend line. So if you draw a trend line here and a trend line here, you short with the stop above that trend line, and then you see how massive and quick that sell-off occurs. All right, and then it bounces back, and this is typically what you see. You'll see a big sell-off until it gets to area that's reasonable, and then buyers will come back in. So you're not looking. I mean, this is a strong stock. Unless there's been news with it, this is not a news deal. This is not a PR, earnings, whatever on the counter trend. The counter trend is just exhausted. It's just done. So you're doing it out of that reason. So the people are there to buy and get in this thing. So it's a quick trade. Usually once you see your first green or significant green candle, for sure you're out of this thing because you were just going for that counter trend. Here's one in the opposite direction where it's gone down, pushes through the Bollinger Band, and then it turns right around and gets a nice bounce. Now it fails and continues down again, but once again, you're looking for that. Remember, there's sellers here for a reason. Comes down, pierces out, you get a little snapback, you put your stop versus the low, and you get a run up. It broke down from this area here, so you're taking profits, and sure enough, that's where it hits resistance, and more sellers come in and push it right back down. You don't really try this a second time, all right? If anything, you're watching to see maybe you can short it, because as this demand is soaked up, it's going to continue on down again. I guess that's what I just showed. So this is the daily on NAV, so it runs up for a few days here. Runs up for a few days. So it breaks through here. I was looking at the 5 minute. I'm looking at the daily. Breaks through. You see this happen. All right. As it gets outside the Bollinger Band, you can go to your 5 minute, and then you're looking for, there it is. It kind of flags. You could go against the low of the day here, and you get a nice run up, flag, a little bit of a pop again, flag, a little bit of a pop again, and you see it does this over a few days till it hits resistance again and goes back down. Okay, what we're trying to cover here. So, any questions? Let me cover real quick, just so I can sleep at night that I covered it. For your rubber band for going long, you want it to be way oversold. So you want your stochastics under 20, at least under 10 is best. You want it having dropped over the last few days. You want it piercing the lower Bollinger Band, and once again, it has to occur over days, not just like one day. You wait for it to open outside the Bollinger Band, or for the best trade, or at least pierce it and get some buying to come in. Open a long position when it shows a little bit of strength, when it goes from red to green intraday, or breaks through a level of resistance. You get some more buy volume come in, and then you're looking for, hey, where's that room to move? Where's my price target before this thing hits significant resistance again and continues on with that downtrend? Because remember, on the counter trend trade, it's a short-term trade unless there's been significant change within the fundamentals or whatever's going on with the stock. All right, as long as it's just a tired stock and whatever way it's going, and you're playing a short-term thing, remember, you're just in this for a short period of time, then you're back out. And the overall reason for it doing whatever it's doing has not changed. So that's a difference from normal. Whenever you're in a stock, you're in it for a reason that's been earnings, PR, upgrade, downgrade, new product, etc. You're in that thing for a while, or you ride it in that trend. In a counter trend, if nothing's changed on the stock, you're just in it for a short term to take advantage of that exhaustion move in the opposite direction. All right, so that's counter trend trading. So now we've gone over. All right, we've done all of our trades. We've done our opening. We've done our breakouts. All right, opening range break, intraday break, high of day break, day long consolidation, flat top, previous day's range, double, triple tap, base breakout, flags, bulls or bears flags, triangle, rectangle. We've done all those. We've done opening reversals where green to red, red to green. We've done pullbacks to bounce, whether that be a moving average, a price, whole number, previous high or low, consolidation area, whatever. We've done our pullback or a throwback on extended runners with those reversals to support and resistance where you're doing that reversal trading. All right, we've talked about dollar rolls. We talked about rubber band snapbacks just now. All right, whether it's rubber band or overextended, whatever you want to call it. And then our double tops and double bottoms we kind of talked about with M reversals and W reversals. Whether that could be we didn't talk about it in depth, but I'll hit it real quick. If you have and go to our M's and W's, our 1, 2, 3 reversals. Those can also be if the highs on the M are kind of the same. That's a double top. It can be a double top where, hey, there's just too much demand up there and it's failed twice and now it just shoots down. On the W, it could be, hey, there's too much supply there and buyers are coming in and that second leg of that W is a little bit higher and then it runs up again. So that can be a double top or a double bottom, just the same. But on a double top or double bottom, you want to make sure that there's support or resistance there. That's facilitating that either double top being resistance or that double bottom being support. So we talked about all of our potential trades out there, and we talked about last night with you, hey, what do you recognize? What's most recognizable to you? What makes the most sense to you? What's easiest for you to pick out on a chart and watch form? And that's what you want to start to trade. All right. Now these are just some closeouts of ways to trade and handle things, and we just want to cover them to make sure you have this information both recorded and then in the book. So this gap trading, real quick, we talked about gaps in depth in defining gaps in the very beginning of the class, but what we want to cover here is traders often get themselves in trouble if they're swinging a stock. So I know you're mainly day trading, but we'll cover this if you're in a swing position and a stock gaps. All right. So if it gaps up, just like we showed a couple examples today on stocks gapping up, that's awesome. That's what you want. Sell a partial position into the gap up at the open, all right, and then move your stop to the bottom of that first candle that marked the gap up. And now you're dealing from a position of strength. You're good to go. If you're in a swing position and your stock gaps down, all right, that's obviously bad. If that stock gap down with significant news, bad earnings, bad news, something bad that drove it down, your outlook on the company has obviously changed. You have no basis to determine how far that thing might fall. We need to get out. All right. If it just gapped down below our stop loss with no news, we want to give it 15 minutes, all right, because you'll typically see 15 to 30 minutes a reversal in the market. And we want to give it 15 minutes to let all the initial emotional selling from people and market maker trading and everything else to settle out, all right. If we see a bounce in there, you want to at least take off half your position into that bounce, all right, if not more. If in 15 minutes the stock bounces back to the buy price or above, it may have just experienced a quick sell-off by large traders that dumped it due to liquidity at the open or market maker pricing. And in that case, you're going to hold the stock and ride it out from there. Okay, so it's hard to take the emotion out of a gap going against you, but that's what you have to do, and that's how you handle it. As far as exhaustion gaps, we covered those in detail. We'll look for rubber bands, snapbacks, either parabolic shorts or longs on those exhaustion gaps. Beware, it's a high-risk trade, as you could, if it's a gap up and it pulls back, it could bring in buyers. Just like if it's a gap down and it comes up, it could bring in more short sellers. So you got to watch those, and you got to have tight stops on those. But those could be good plays. The book, I think we have it up here too. Yeah, this is in your book on page 86, but a lot of stuff going on with Netflix back here. Gap down, continues down, all right. Gap up, flag, run, flag, run, flag, run, all right. And then it comes into resistance, new price resistance here. where it fails. It fails at the 20, bear flags there, goes down, hits the 20 again, resistance, goes down. This, remember, gaps act as vacuums once price gets back to them. Trend line, look how it follows the trend line down to fill that gap. Attempts a little bit of a bounce back down again, and then some news comes in, gaps up, fails at the Bollinger Band. That could be a short. After a big gap up like this, runs into resistance at the Bollinger Band, which is also right at previous price resistance, and then massive 4-day sell-off, gaps down here, pierces the Bollinger Band. This is a reversal hammer candle here on all this buying. From that, you get a little flag and then gaps up. All right, resistance at the 200 fails. Prior price support runs up again, pauses for a second at the 200, flags, runs up, and then, you know, it's just this chart. You can see a million things, a million ways to trade. A gap again, right in the Bollinger Band. Doesn't finish on highs because it hits the Bollinger Band. Like, you can just talk all day about this one chart on all the stuff that happened. And we'll kind of describe it for you in the book there on page 85, but that's where you want to have, you know, the game plan is going to come in from your daily and what you're seeing on the daily, and then look for those opportunities to trade in your on your 5-minute or 1-minute chart or whatever. And that's just kind of what I want to capture for you on this. I kind of threw a lot out there on that one. Sympathy play, you've talked about it, we've talked about it. You know, it's similar stocks within a sector performing in a like manner. All right, can make that all the stocks in there in play. What's running right now? Talk of interest rates rising. Financials are all doing well. Solars run together a lot. Airlines were all going down together. Why? Because oil, the price talks about oil issues there, which hasn't really moved to oil, so I don't understand. But for a while, airlines, you know, transports as a whole were getting crushed. So those are where you can do sympathy plays within a sector. But your real sympathy plays comes in when, you know, there's a big news on one particular stock within a sector that others might benefit from. When could that occur? Let's say earnings. Well, if one stock reports earlier on in the earnings reporting season and the other stock reports later on in the season, and you see good earnings out of a like stock early on in earnings, and that moves, but it moves too fast, you may go to another stock in that sector that reports earnings 2 weeks from now and get in on that, thinking that there might be some sympathy on that thing moving up as well. What else? I know Doug was talking about it earlier. Right now, wearable cameras, tasers, things like that, like going on after Ferguson. You know, you'd see one move, and then you see someone else come out and say, "Hey, we're going to start making those now," and that one would take off, and you could play those sympathy plays. So, you know, like I said, we've talked about it. The concept is all about psychology. If one stock performs extremely well or extremely poor for a reasonable reason that others might do the same, investors, you know, can jump into another stock, creating a wave of buying or selling that you can take advantage of. You know, the idea being that you missed the original move on the in-play stock, but we're looking for a sympathy move in like stocks in that same sector. Guilt by association, whether good or bad. Look for patterns just the same as you would anything else whenever you enter those trades. And you've got a snapshot in the book, and I showed you this on TC2000. This is a solar example where, you know, SCTY made a massive jump early in the morning. Eventually it flags and gives you an entry. But that massive jump, there was no way to get in on that. So what you do is just go up and pull your sector search like I showed you, and you know, you can arrange them by largest gain percent or highest increase of volume, scroll through and see if there's any other valid setups for a like stock within that sector to get into. A lot of times you can be patient and look for the one that is running for a pattern to develop, and then you can get in on that. The combo trade, we also talked about this already. That's just simply, you know, you have to be aware that you have overnight buying power and you have day tradable buying power, and they're not the same. So if you're going to swing something, the first thing to do is make sure you downsize enough to your overnight marginable buying power. And the idea is a stock finishes near the high of the days. In that same example, you can look at Solar City in your book on page 87. And I mean, there's no reason to exit out of that stock unless there's some massive resistance on the daily right there or something. You know, it ran today, likelihood, unless the market's looking bad for the next day, that it's going to, you know, continue on the next day. So take profits and swing the rest, and that's all the combo trade is just keeping some of your shares from one day into the next day to look for that gap up, and then you're going to use the gap handling rules that we talked about. If it gaps up at the open, sell some more into that. If it gaps down, wait 15 minutes based on why it gapped down. You know, has it changed? If it fundamentally has changed, then we're done. If it hasn't fundamentally changed, then let's see if the motion stuff comes out of that. If it's just profit taking by big boys and it goes back up again, then we're good to go. But that's why that's in this section of going in, hey, what I do on a gap that goes with me, against me, etc. on that. I think there's a couple examples here. He's using Hain. Yeah, so I mean, right here, just like Solar City in the book, is there any reason to be out of this trade? I mean, it finished no shit the high of the day, minus maybe a penny or two. Like, that's beautiful. You entered it down here on this pullback or this flag, whatever, added maybe, you know, and then in here took some profits, but as it goes up again, you still got some. Sell a few into this right here, keep some for overnight. Gaps up, sell into this first candle, and then put your stop below. Either below the bottom of the candle or below the solid portion of where it closed, and you just wait and see, and you actually get a little more profit out of it. All right, so with that, Doug, do you have anything to add on any of these or any? I think he's good over there. We talked about. We finished out from last night. We talked about counter trend trades, gap, how to handle gap. When would you be in a gap with your swinging, or if you did a combo trade? We talked about sympathy plays again. We've kind of mentioned that before, and then obviously the combo trades. Just continue on with your charts and familiarizing yourself. Do scans. Think about how you would look at something. I know you don't have a lot of time during the day to trade, but do some scans at night. Watch those videos that we showed you. If you haven't signed up yet, sign up for like you know, T3 Live, the Stock Trading to Go, and watch those at night and start getting an idea of some stocks that you want to watch, and then at night look at them, and at least like I did tonight with you at the beginning of class, look at what your trade plan would be for the next day. Okay, is this something I'm interested in? What would I do if, you know, those if-then statements we talked about? What would I do if it does this? Where do I think it can go up to? Where do I think it can go down to? What's my plan? What's my favorite type of setup? Those kinds of things are what you want to start thinking about. Tomorrow night, or not tomorrow night, sorry, I know we're off tomorrow night. I can do next Monday. I can't do next Tuesday. I'm good Monday, Wednesday, Thursday. Greg, when are you good next week?
I'm good Monday and Wednesday.
Okay, perfect. So we need that's all we need is 2 nights, and we're done with the classes. So we'll do Monday and Wednesday next week. Monday we'll talk about managing winners, keys to success, grading the trade, risk management, sizing, and handling bad trading days. A lot of stuff. It's just a little more in depth than the intro course on those things. With that, what questions do you have?
I'm good. I'll just review everything. Keep going over it.
Okay. Are you watching those T3 lives at night, or I mean, I know we have this class, so I don't know if you have time or not, but I
mean, I've been through all the sites. I haven't started consuming a lot of the. I mean, I've started reviewing like the daily
recap.
Some of that, and then like the like that blog list I have. I review it on my phone. Every morning, and then sometimes in the evening, as well as some of the Twitter feeds during the day, and then. But I haven't gotten into kind of more in-depth research through the websites themselves yet. So I gotta.
Okay, fair enough. Just try to at night if you can. Just look at a couple of charts and see. At least start thinking. You don't have to look at any charts. If nothing else, just go. Okay, hey, I'm gonna at night. I'm gonna be looking at. This is my game plan. I'm gonna look at the Bollinger Band high and low. I'm gonna look at where the 20 is, where the 50 is, where the 200 is. I'm going to look at my room to move, and just kind of start thinking about in your head when you do look, what you're going to look at night, and how you're going to formulate your trade plan on a stock that you're going to watch for the next day, even if no stock exists.
Yeah. Okay.
Fair enough.
Yep.
Awesome. Doug, anything else? Okay, so Monday and Wednesday of next week, and I'll be home in St. Louis on Monday. I think I can make this work there. If not, we'll have to flex. We'll go through the plan for Monday. Will be me giving this class from home. If that fails, then Doug will do trade review from Thursday, Friday, and Monday from what he traded. Sound good?
Okay. Yep.
So we have a backup plan at least. I should be fine, but I don't know why I wouldn't be, but just in case. All right, awesome, guys. Have a good night, Greg, and we will talk to you Monday night.
You too. Thanks a lot.
Yep, we'll see you.
Take care. See you.